Welcome to The Explainer. Today we're digging into the latest annual results for CDL Hospitality Trusts, CDLHT. Now, on the surface, their main profit number actually went down, but trust me, the real story here is way more interesting. Let's get into it. So here's how we're going to break it all down. First up, we'll take a peek at what's actually in their portfolio. Then we'll hit the big numbers, both the good and, well, the not so good. We're going to uncover the real story behind their mixed results, check out their game plan for the future, and then wrap up with the key takeaways for anyone keeping an eye on this company. All right, so to really get a handle on CDLHT's performance, you've got to know what they own. So let's take a quick look at their global portfolio to see where the money's really coming from. This slide basically shows you their financial DNA. I mean, look at that. They are seriously anchored in Singapore, with nearly 60% of their profit coming from right there at home. Europe is the other big piece of the puzzle at over 26%. And this geographic split, it's absolutely key to understanding everything else we're about to talk about.
Okay, before we go any further, let's make sure we're all on the same page with this term, NPI, or net property income. Just think of it like the gross profit of a hotel. It's all the income they collect minus the direct costs of just running the building. It is the single most important number for judging how profitable their actual properties are.
And their portfolio isn't just about location, it's also about the type of property. Hotels are still their bread and butter, no doubt, but they're making a really strategic move into what they call the living sector. We're talking rental apartments and student housing. For an investor, that's a really interesting shift away from the ups and downs of tourism towards more stable, predictable income. Okay, so let's move on to the headline numbers and see how this all played out in their 2025 performance. We'll kick things off with the good news.
So the top line story is pretty positive. Revenue grew by 2.8%, hitting almost 268 million Singapore dollars. And this growth was really driven by solid results in Australia and Japan, plus a really important contribution from their new UK assets. And right here, this is where that diversification strategy starts to pay off. Their new UK living sector properties alone added a cool $8.2 million to NPI in their very first year. It's a super clear sign that their big strategic pivot is actually working.
In fact, if we zoom out and look at their entire UK portfolio, the impact is even more dramatic. When you combine those new living assets with their existing UK hotels, the total net property income from the UK just exploded, up by over 54% in just 1 year. That is a massive boost from a single market.
But, and this is a big but, as strong as that UK growth was, it wasn't the whole story. The main profit metric we talked about, that all-important NPI, actually fell for the group as a whole. This is where the results get a little tricky, and we really need to understand exactly why that happened. So here it is, the headline number that probably caused some concern, a 4.1% drop in net property income. Now, on the surface, that's not what you want to see. It kind of suggests that even with higher revenues, the whole portfolio got less profitable. But the real story, it's a bit more complicated than that. Okay, so here's the crucial detail, the real key to the whole story. That 4.1% drop, it was almost entirely caused by 2 major hotels being shut down for renovations. If you just pull those out of the equation for a second, ignore that temporary disruption, the core portfolio's profit actually grew. It means the underlying business is healthier than that scary headline number makes it seem. Now, renovations weren't the only challenge they faced. Some of their markets hit some real headwinds. Their Maldives resorts, for example, saw a drop in a key hotel metric called RevPAR. That's revenue per available room. It's basically a scorecard for how well a hotel is filling its rooms at a good price. And that drop was because of some really tough competition and a few booking disruptions while they were rebranding a hotel. And, we saw a similar kind of story in parts of Europe. Their hotel in Munich saw profits fall, but that was mainly because it was being compared to an exceptionally strong 2024 that was boosted by huge events. Then in Florence, Italy, the problem was different. A bunch of new hotels opened up, which meant more competition, and that put pressure on their performance. So with this mixed bag of results, you've got strong growth in some areas, temporary hiccups in others, and some real softness in a few markets. What does the road ahead look like? What are the key things investors should be watching for as we head into 2026? Their strategy moving forward has 3 pretty clear pillars. First, keep on diversifying into those more stable assets like student and rental housing. Second, squeeze every last bit of performance out of their current hotels. And third, use their very powerful parent companies to find new properties to snap up. The single biggest opportunity for 2026 is, honestly, pretty straightforward. Those major renovations that drag down the 2025 numbers, they're done, finished. With big assets like the W Hotel in Singapore back to full strength, they're perfectly positioned for a big performance rebound. That should give a really nice, natural tailwind to their NPI. But of course, it's not all clear skies ahead. Investors should definitely be watching for a few potential risks. The company itself has flagged that trading is a bit softer in some of its UK markets, and after a record-breaking run for tourism, Japan is expected to cool off a bit, with a forecast 2.8% dip in foreign visitors. These are definitely headwinds they're going to have to navigate. Okay, let's bring it all home. We've looked at the portfolio, we've crunched the numbers, and we've peered into the future. Now let's boil this all down to the most important takeaways from their 2025 results. So here's the entire year in a nutshell. Revenue is growing, which is great. That headline profit dip was pretty much a temporary problem caused by renovations, and it was hiding a stable underlying business. Their big bet on the UK living sector is already working, and maybe most importantly, those disruptive renovations are now in the rearview mirror, which creates a really clear path for a recovery. And all of this leaves us with the central question for the year ahead. You've got these two opposing forces at play, right? On one hand, you have the tailwind from the newly renovated hotels coming back online. On the other, you have the headwind of softening demand in some key markets. The big question for investors is, will that recovery be strong enough to power through the challenges in other parts of the portfolio? That is going to be the story to watch in 2026. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.